Ever wondered how to read trading candlesticks? Well, you're in for a treat. Trading candlesticks, or simply candlesticks, are like the alphabet of the trading language. They are graphical representations that depict price movements of a security, derivative, or currency over a specified time period. Imagine a storyteller narrating tales of the market's highs and lows, its opening and closing dramas, and the tug-of-war between buyers and sellers. That's what a candlestick does. It's a storyteller of the financial market. They originated from Japan, over 3 centuries ago, and have become an essential tool in technical analysis worldwide. Candlesticks are used by traders to make sense of the market trends and to predict future price movements. So, essentially, if you're planning to surf the waves of the financial market, understanding candlesticks is your surfboard. Now that you know what trading candlesticks are, let's delve deeper into how to read them. A candlestick is not as complicated as it looks. It's all about understanding its components. Let's start with the basic structure of a candlestick. Imagine a rectangular box with 2 thin lines sticking out from the top and bottom. This box, known as the body, represents the range between the opening and closing prices during a specific period. The thin lines, or wicks, extend from the body to the highest and lowest prices reached during the same period. The opening price is where trading starts for the period, while the closing price is where it ends. If the closing price is higher than the opening price, we have what we call a bullish or green candlestick. This means that the market was in an uptrend during that period. The bottom of the body shows the opening price, and the top shows the closing price. On the other hand, if the closing price is lower than the opening price, we have a bearish or red candlestick. This signals a downtrend in the market. For bearish candlesticks, the top of the body represents the opening price, and the bottom represents the closing price. Now, let's move on to the wicks. The top wick, also known as the upper shadow, shows the highest price during the trading period. Conversely, the bottom wick, or the lower shadow, indicates the lowest price. The length of these wicks can give you an idea of the volatility of the market during that period. Longer wicks mean more price fluctuation, while shorter wicks mean less. Understanding these parts of a candlestick can give you a snapshot of market sentiment during a specific period. It tells a story of the tug-of-war between buyers pushing prices up and sellers pulling prices down. So, there you have it. The anatomy of a candlestick. Open, close, high, low prices, bullish and bearish candlesticks, and what they all mean. It's like learning a new language. A language of patterns and trends that can help you make sense of the market's complex movements. With the anatomy clear, you're one step closer to reading candlesticks like a pro. Patterns are the language of candlesticks. They tell a story of market sentiment. Just like a book, each candlestick pattern unfolds a new chapter in the narrative of the market. These patterns are not just random arrangements of lines and shapes. They are instead a complex yet decipherable language which can unveil the market's mood swings, its fears and desires. Now let's delve into the world of candlestick patterns. These patterns are combinations of candlesticks that form over a specific period of time, and they can indicate potential price reversals or continuations. Think of them as the market's body language, subtle hints of what might be coming next. Among the myriad of patterns, some show up more frequently and are easier to recognize. Let's touch upon a few of them. First up, we have the doji. A doji is when the opening and closing prices are virtually the same. It's like a tightrope walker balancing on a wire, representing an equilibrium between buyers and sellers. A doji can signal that the current trend may be nearing its end. Next, we have the hammer. A hammer pattern has a small body and a long lower shadow resembling, well, a hammer. This pattern often forms during a downtrend, hinting that the market might be hammering out a bottom, and a reversal could be imminent. Lastly, let's talk about the engulfing pattern. This occurs when a candlestick completely engulfs the one before it. Imagine a large wave washing over a smaller one. This could indicate a strong shift in sentiment, suggesting that a reversal may be on the horizon. Remember, while these patterns can provide valuable insights, they are not foolproof. They are more like clues rather than definitive predictions. However, combining them with other technical analysis tools can increase their predictive power. So, keep your eyes peeled for these patterns. Train your eyes to spot them, understand what they signify, and use them to your advantage. After all, understanding the language of the market can be a powerful tool in your trading arsenal. Recognizing these patterns will give you an edge in predicting future price movements. Knowing the patterns is good, but applying them is what counts. Now let's dive into the practical application of these intriguing candlestick patterns. The real-world trading arena is where they truly shine. When you spot a pattern, it's tempting to jump right in and make a trade, but hold your horses. It's crucial to wait for a confirmation. This could be another candlestick completing the pattern, or a trend line or resistance level being broken. Confirmations are the green light in the world of trading. Context is another key player. Candlestick patterns don't exist in isolation. They're part of a broader market picture. Is the pattern forming at the peak of an uptrend or the bottom of a downtrend? The market's direction and momentum can add weight to your candlestick signals. Remember, candlestick patterns are like the pieces of a puzzle. They're most effective when combined with other technical analysis tools. So, don't rush. Take your time to analyze and make informed trading decisions. Remember, candlesticks are not standalone indicators. They work best when used in conjunction with other technical analysis tools. So, that's a quick run-through on trading candlesticks. From the get-go, we dove into the world of candlesticks, shedding light on what they are, a visual representation of a specified time frame's trading action. We unpacked the anatomy of a candlestick, the body and the wicks, and how they detail the open, close, high, and low prices. We also explored the colorful world of red and green candlesticks. Remember, a green or bullish candlestick indicates that the closing price was higher than the opening price. In contrast, a red or bearish candlestick shows that the closing price was lower. Our journey didn't stop there. We delved into the patterns formed by these candlesticks, from simple ones to the complex. These patterns, when understood correctly, can provide insightful signals for potential market movements. Finally, we discussed the practical application of these patterns, the heart of any trading strategy. Remember, these patterns are not predictions, but probabilities. With practice and patience, you'll be able to decipher the story that each candlestick tells and make informed trading decisions.